Hi, I'm Beth Harrington. Welcome to today's question of the week. Today's question comes from one of our doctor clients, Dr. John, who is 70 and a half, and he's required to take a minimum distribution from his 401k plan this year. So I thought since it's that time of year, it might be a good idea to do a little video on required minimum distributions in conjunction with a blog post that we're putting up today on the same topic. So first of all, who is required to take a minimum distribution out of his or her retirement plan? So if you're an inactive employee, you no longer are working, or you own more than 5% of the company's stock, then you are required to take a minimum distribution from your retirement account once you have attained age 70 and a half. So in our case, Dr. John is the owner of his practice, and he's 70 and a half in 2013, so his first required minimum distribution will be coming up this year. So that's who is required to take a required minimum distribution. The next question is when. Every year, once you start taking your RMDs, you're required to continue. The exception is the first year. So if Dr. John attained age 70 and a half in 2013, he can take his first RMD on December 31st, 2013, or he actually can elect to delay until April 1st of 2014. The delay is fine, but he will have another distribution required at the end of 2014. So he's working with his tax professional to decide whether it's better to take one distribution in 2013, one distribution in 2014, or if it would be better for him to go ahead and take both distributions in 2014. The only time you have the extension to April 1st is the very first year, so the year in which you attain age 70 and a half, you can do it that year or delay until April 1st. The next question is what accounts must have an RMD come from them. So every 401k plan, every pension plan, every 403b plan must have an RMD processed from that account. IRAs are different. With an IRA, you can consolidate all of your IRAs into one calculation, and you don't have to take a separate RMD from every single IRA. You can actually just choose to take it from one or two or whatever number of IRAs that you want. Now you're going to have to communicate with your IRA providers because all of them will be sending you emails and letters saying you have to take your 70 and a half minimum distribution, but just so you know, and you can work with your tax preparer and your financial advisors, but the IRAs can be consolidated and only one account has to have the RMD. The calculations of the RMD are actually pretty simple. You take your balance at the end of the prior year. So in our friend Dr. John, we're taking his balance at 12/31/12 and dividing that by the Uniform Lifetime Table factor for someone who's age 70. And that factor is 27.4. So we take his balance at 12/31/12 divided by 27.4, and that's the amount that he needs to take either by December 31st this year or, as we discussed, April 1st, 2014. So every year you look at your balance, you look up your factor on the table, and come up with your RMD for that year. You can take your RMD anytime. Some people like to take it early in the year to take advantage of the withdrawal and not pay tax until 12 or 14 months later, and some people like to delay and keep the tax-free growth as long as possible. So again, that's a question for your tax advisor and your financial advisor. I just wanted to point out the rules to you. If you fail to take out a required minimum distribution on time, the penalty is significant. It's 50% of the amount you should have withdrawn. So if you should have withdrawn $14,000 on your RMD and you fail to do it on time, the penalty for that is $7,000. So you can imagine that adds up pretty quickly. So pay attention. I think that's why we have a delay factor the first year, because a lot of people might not realize it sneaks up on them. So there is a significant penalty. There is a voluntary compliance program available through the IRS. If you fail to make your RMD timely, then we can go to the IRS and ask for an exception for you and ask them to waive the penalty. In some cases, the cost for Benefit Resources to prepare that filing and the IRS submission fee is less than the penalty, since the penalty is so significant. So again, we're trying to work with all of our clients. We're contacting all of our business owners who are 70 and a half who are required to take their distributions, make sure that they've been processed, make sure that they've been calculated, because we really are standing shoulder to shoulder with our clients to make sure that they meet all of these regulations. If your TPA is not doing the same thing, or if you have a problem with your RMD, you're really more than welcome to contact us. Read our blog post on RMDs, it's next to us, or click on the button next to me and we're happy to give you a call or answer your email or whatever questions you might have about required minimum distributions for those of you attaining age 70 and a half. Thank you so much for joining us, and come back next week for another question of the week.